Hello value investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. On Fridays we talk about how to buy stocks and my investment strategy, and I hope that this resonates with you and I hope you find it useful. So just a quick announcement, got a price hike coming in September, so make sure to get in before the price hike. If you have any doubts, you shouldn't be in any doubts, but if you have any doubts over my marketplace, check out my reviews. Got plenty of 5-star reviews and you can look for those and see if it's something that resonates with you. And I'm not going to replace you as a source of ideas. It's just really a marketplace where you can come in and check out, get 1 or 2 investment ideas to see if it works for you. So anyway, let's get into the meat of the argument today. So the thing is with investing, it's not really about a get rich quick scheme. So I've done some maths here, and just very quickly, let's say you're a great investor, okay? So you can do a compounded annual growth rate of 16%, okay? So you put 5K down in year 1, after 20 years, compounding at 16%, you come out with 94K. That's good, that's fair enough. Option B, you're not that great an investor, you do a 13% compounded, start with the same 5K, but on the first of each month, irrespective of market being up or down, you add in $500. It's not a lot, $500, if you save, you can do that. And at the end of the same 20 years, despite growing at a significantly lower rate, you end up with 514K. So the game here is really to stick with it. And that's what I want to talk about today. So you need to develop a process in investing that allows you as the investor to stay with it. So no strategy is going to work out positively all the time. You need a strategy that allows you to stick with your investment thesis. So the way that I do it is that I try and buy companies that have strong insider management, strong insider ownership. Management that is very much incentivized to deliver you strong returns. I'm looking for companies that are high quality companies. This doesn't necessarily mean the company is growing very fast. It could be a company that is kind of just ticking along, but makes a lot of free cash flow. But ultimately, when it all boils down to it, what you're doing is trying to overcome your investment behavioral psychology. So by that I mean there are going to be moments in time where things are kind of choppy and you're trying to read into stuff that isn't there. What you need to remove is you from your investment strategy. You need to do it in a way that allows you to stay in the market through thick and thin. So sometimes the market is kind of acting like falling like a rock, and it's really tough. You invested in a certain area of the market, and it's just falling, and the rest of the market seems to be doing better. So the grass is always going to be greener on the other side. And by you selling out of things that have been out of favor right now and trying to go into something else that is in favor, that thing that is in favor is also in the next quarter or the next 6 months is going to be out of favor. And you're just going to be moving around your capital, and every time you're not really getting the worthwhile return that you deserve. If you stick with your strategy and you understand, okay, you got a diversified portfolio, let's say you got 8 or 14 companies, or maybe you don't need a lot more than that, but something around those lines, and you stick with your business, you stick with your process, you're going to be able to stay in the game, and you're going to be able to be compounding at, let's say, close to 13%, and you can stick to the game for 20 years, and then you're going to have a substantial amount of wealth. So the game is really how do you deal with your behavior, how you detach the human you from your investment process. So it's a lot about position sizing, it's a lot about being honest with yourself and recognizing that if you're lucky and you look for 5 different businesses, it might just be one of those businesses that really works out favorably. You're going to have a relatively high failure rate, and you need to understand that, because in investing it's really about recognizing that there is going to be a failure rate and having a method in place not to get emotional about it, but to stick with the process. So you have to position size, that's important. You don't want to be too aggressive at first, because you don't know a business until you've been invested in business. Once you've been invested in that business, then you can think like the owner of that business. So what was it I tell investors, in the marketplace, say, okay, don't think so much about the share price. think more about the business. Where is the business going to be in 2 or 3 years? There's a Buffett quote that talks about, I wouldn't mind if the market was closed for and only open for 1 day a year. So that's it. You want to try and buy these stocks, but you're trying to buy the business, and you're trying to have a probabilistic idea that the business can go in a certain trajectory over the next 2-3 years. You don't necessarily need to own it for 2 or 3 years, but you're trying to think over the next 2 or 3 years it's going in this direction, and in 2 years' time someone's going to be willing to buy this business from me at a high valuation. So anyway, I hope you found this video useful. Hope you gave you some food for thought. Hope you check out my marketplace. You're welcome to do a totally free trial to see if it suits you. If you like it, you stick around, and hopefully get in touch in the marketplace. See you soon. Bye bye.